What's up guys, welcome to my channel. In this video, I'm going to dissect the timeless investment strategies that Warren Buffett has used to build his $136 billion fortune. And all of these strategies can also be applied today. Warren Buffett first started investing at the age of 11 and his first acquisition was 3 shares of City Services which he bought for $38 a piece. Before that, during the ages from 7 to 10, he spent his time observing the world around him. Although he didn't dive into investments until a little later, he said those formative years sparked his curiosity. So when he first bought his stock, he was ready to dive into the world of finance. An important lesson here is irrespective of whether you want to get into investing or something else, the most important thing is to observe the world around you. See if there is something that you are keen to learn more. See if something sparks your curiosity and then deep dive into it. Building that base will certainly help you get a lot of clarity moving forward. He continued doing this over the next few years, wherein he experimented with various strategies, charting, and also timing the market. According to him, all of these activities were fun and he learned a lot, but none of them made him profitable. He did this until he was 19, so for 8 years, and by this time he had devoured every single book in the public library on finance. But he still felt that he lacked a solid framework. A lesson here is to build a solid framework in anything that you want to do, as that will form the backbone of the strategy that you want to apply. Buffett's fortunes, however, changed in 1949 when he was introduced to the book The Intelligent Investor by Benjamin Graham. This book gave him the 3 key principles which form the basis of his investment strategy going forward. Let's break them down one by one. The first principle to understand here is that buying a stock means buying a part of a business. So let's just say we have a company, Apple, and Apple issues about 100 stocks. Out of the 100, if you buy 1 stock, that means you own 1% of Apple. Buffett here first realized that in order for you to evaluate a stock, you must evaluate the business behind it. In order to evaluate a business, you must first evaluate the economic aspects behind it. What is the revenue like? How much do they sell the product or the services for? What is the total cost for selling all of these products and services? Who are the customers? Which markets do they sell in? Then it is important to understand the competitive landscape as to who the competitors are in this space. And lastly is the management aspect, who the management is, how much experience do they have in the industry in which they are selling their products or services in. Although by the age of 12, Buffett knew every single ticker symbol on the New York Stock Exchange, his investment strategy changed when he started looking at these stocks as more of a value and the business behind it, rather than just a ticker symbol. This is when he first started seeing success as an investor. The second principle is learning how to react to market volatility. In The Intelligent Investor, Ben Graham introduces the concept of Mr. Market. Mr. Market is a mythical figure representing the market volatility. Mr. Market gives you different prices every day. The key here is to take advantage of Mr. Market's manic depressive state to buy and sell when Mr. Market is overly enthusiastic. What this exactly means is buying when the market is on a low, such as, for example, this time during the pandemic, people who bought stocks during this time are very well versed in today's age because the market has just gone up since the crash that we saw during the pandemic. And selling at a high means when the market is really high, that is exactly the right time to sell. This particularly taught Buffett to remain calm, focusing more on the long-term value rather than focusing on the short-term movements in the market. And this is exactly what I have been doing with my investments. Although as compared to many others, I am more leveraged with about 70% of my portfolio being in stocks and 30% in the S&P 500 index fund. For the stocks that I have bought, I'm very confident about the strategies that I have applied and I'm ignoring the short-term fluctuations in the market and focusing on the long-term value that these assets will get me. The third principle is margin of safety. In The Intelligent Investor, Ben Graham emphasized on the importance of leaving a cushion when it comes to investing. This for Buffett means being within the limits and leaving some room for error. Consider it this way. You have a bridge that has a capacity of about 10,000 pounds. If there's a truck that weighs about 9,800 pounds, you wouldn't want to take that truck on this bridge. You're better off finding another bridge. And this is because you want to leave that little bit of room for margin of safety and you don't want to go through any of the unexpected challenges that may arise by running that truck on the 10,000 pound capacity bridge. This is the same principle that is applied during investing. These 3 key principles of viewing stocks as a business, understanding market fluctuations, and leaving a margin of safety form the core of Warren Buffett's investment strategy. Now let's take a look at how he applies all of these in practice. When evaluating these companies, Buffett looks for companies that have enduring competitive advantages. These types of companies often have a moat, that is something that protects them from competition, like a strong brand, a patent, or a prime location. For example, Coca-Cola is a brand known worldwide. People associate Coke with happiness. This gives it an enduring competitive advantage, which makes it very difficult for competitors to take its place. Buffett also emphasizes on the importance of investing in companies that are run by honest and capable management. He firmly believes that any company, no matter how big it is, can fail when it is run by poor leadership. And lastly, he speaks about sensitivity in terms of the price. No matter what the company is, if the price isn't right, it does not make any sense to invest in that company. If you apply these principles, you probably may not be able to amass a wealth of about 136 billion, but you'll be well on your way towards making a fortune for yourself in the future. Click here to learn how to invest as beginner, or watch another video on my channel. Like and subscribe if you haven't, and I'll see you next time.